Welcome to Wealthion. I'm Eric Chemi. So much conversation going on right now. If the Fed is at the right interest rates, are we going to see a soft landing, a hard landing, or no landing at all? And are equities at all-time highs a good buy right now? So much to ponder. To talk more about this today, we've got Sam Burns. He is the investment brain behind Mill Street Research. Sam, thank you so much for joining me on the show. And I got to start with what's got you worried? What's keeping you up at night right now?
Well, yeah, I guess I would say in general, I'm probably a little more on the more positive side relative to some of my strategist colleagues. But the thing that would worry me for this year really is if growth slows down more than people expect. Last year was all about too much growth and too much inflation. I think the problem this year would be too little. If the Fed stays too tight, or there's another big shock from wars or the Middle East or something like that, I think the domestic U.S. economy is probably okay. But the thing that gets me, worried is things that are outside the U.S. and much less sort of under the control of the domestic economic situation here.
So you know what gets me is, so your latest portfolio strategy note coming out, just came out January 17th, right? So it's just days old. You're increasing your overweight in stocks. And here we are at all-time highs, right? And I've been asking other people, do I really want to be buying stocks at all-time highs, right? The last time we saw this 2 years ago, wasn't it like the first day of the year, 2022, right? Like Jan 2 was the high, and it went straight down the rest of the year, and it never came back all the way up until now. And here you are saying, I'm not just staying long, I'm getting more long right now. Tell me about that.
Yeah, no, you're right. I mean, psychologically, for a lot of people, buying it, after things have moved up a lot or they're at highs is very difficult. It seems like you've missed it, and it seems like it's got to be the wrong time to buy. Now, if you look back, historically, the market spent a fair amount of time, making new highs or being close to their highs. So even though, yeah, you can certainly pick points where it would have been a bad time to buy, that's often not the case. And in my mind, it's more a matter of we've been through 2 years of basically no returns. So it's not like we're really extended on a longer term standpoint. We've got some momentum over the last few months, and that's part of the reason that I think we'll continue to go up, or at least stay positive for a while longer. But I think that the fact that the interest rate backdrop is shifting from one of higher rates to one of at least stable or lower rates, inflation has become much less of a problem, and earnings are holding up, means that stocks are going to be better than the alternative. So bonds, cash, other assets. I think U.S. stocks in particular are going to beat the alternatives. So that's why you got to be overweight.
The classic TINA, right? TINA, there is no alternative to stocks. Is that really your thesis though? Is it just more, I don't love stocks, but I hate everything else more? And I don't want to be in stocks, but I've got no choice? Or is it that you're like saying, no, I really want to be in stocks regardless of the alternatives right now?
Well, no, I think do have a more positive view on equities and have for over a year now, and sort of kind of maintained that. And I think that a lot of it is because earnings are in fact still rising, and that's what drives stocks in the longer term. And but you do have an alternative now that you didn't have a couple of years ago, in the fact that cash yields 4 or 5%, and so that is an alternative, and certainly a better one than we have had for most of the last 10 or 20 years, where rates have been much lower. So it's less a matter of I hate everything else, as a matter of if you have a relatively solid economy and moderate inflation, and the fact that rates could come down, that's usually better for stocks than for other assets. So bonds don't get to benefit from growth, stocks do. And so if you think there's going to be some growth still, stocks are the asset that benefits most from that.
So that's a good point. You mentioned cash is yielding 5% right now, right? Or just the safest bonds. So you got to be pretty confident that you're going to get even a lot more than 5% on returns, given the risk involved, right? So what do you see as this year, 2024, let's call it large cap S&P 500 kind of return? My guess is you're expecting more than 5%.
Yeah, no, my guess would be that you get more than 5%, and that that something in the 10 to 15% range would probably be historically typical. If you figure that 2022, the end of 2022 was kind of a bear market low in some ways, that we're only a little over a year into this. Bull market cycles tend to last significantly longer than this. 3 to 4 years is more typical. So I think on a time basis, you've got more time, and I think on a kind of a earnings and valuation basis, there's potentially somewhat more to go there. So I think there is more upside for stocks. I think cash is fine in the sense that you want to probably have some in the sense just as an asset allocation thing. But I think overall, stocks will give you a better return than cash will.
And then, one of the things you talk about in your report here is removing the Fed headwind has allowed risk appetite to return. Your view is the Fed will likely cut rates this year, maybe not as aggressively as the bond market thinks, but the trend in rates is lower instead of higher. And we have Howard Marks out there, right, the billionaire hedge fund manager, on Tuesday talking about rates being closer to more to 3% rather than these five numbers and being artificially high. Do you see this aggressive cutting cycle here making a big difference?
Well, in my mind, it's less about kind of how much or how aggressively the Fed cuts, as the fact that there are cuts on the table. They're openly discussing lower rates, and they realize that rates now are almost certainly too high, meaning that the 5 or 5.5% policy rates in a 2 to 3% inflation environment is excessively tight. That's higher than they need to be, and then it's just a question of how far and how fast they want to kind of bring things down. I mean, if you remember, the last time this really happened was almost 30 years ago in 1995, when we had the economy slowed down, inflation came down, but there wasn't a recession, and it was essentially a soft landing. And the Fed cut rates, I think, 3 times from the peak, and that was enough to set off a strong bull market, big gains in stocks, and a pretty solid economy in 95, 96, 97. And so I think that's what kind of some people are looking at it as kind of a historical analog. You don't need a huge number of cuts as long as rates are kind of high and moving down. That means that you've got, again, a tailwind rather than a headwind, and the Fed's realized that it's probably too tight and is looking to loosen.
Dig into that a little more, because I think I want people to really reflect that it's not how many cuts you make. It's not how aggressive your cutting policy is, just the fact that you are cutting. You think just the direction itself is all that matters.
I think so in general, yeah, in terms of just getting investors to think along those ways and to have a risk appetite. Like the 5% that you're getting in the money market right now won't last. That 6 months or a year from now, it might be 4 or something less. I don't know, but it won't be as high as it is now. And so you got to think about, if you're going to allocate long-term money, do you want to put it in a money market fund and have that the interest rate go down, or do you want to think about other assets that can participate in longer-term growth? As long as you kind of think that the general U.S. economy will hold up and earnings will hold up, not go into a bad recession and falling earnings and things. So I think as long as you're reasonably comfortable with that general perspective, which I am for now at least, then that makes stocks a more attractive asset class, even relative to what looks like a high rate now that may not last.
And before we turn to stocks in a second, I want to just focus a little bit, because I'm not sure I agree on this, right? You're saying inflation over the last couple of years was mostly due to COVID and Ukraine, supply shocks, a little bit from fiscal stimulus, and had relatively little to do with the Fed. It's not the 1970s. I was under the sort of impression, right, from sort of my reading, that this was all from government stimulus, right? And that Ukraine doesn't have that much of an impact on what we're doing here. And that the COVID stimulus, right? The COVID stimulus, the big government spending plans, whether it was, I lose track of the name, Build Back Better or Inflation Reduction Act, but to me is like the Inflation Increasing Act, right? Because they're putting more money into the economy. All the stimulus, all the just free money for people. To me, that felt like that's probably why prices are up. But tell me why I'm wrong here.
Well, I mean, there was definitely an influence from the stimulus, both from the COVID stimulus and the more infrastructure-related stimulus that came along, somewhat later, the Inflation Reduction Act, the Infrastructure Act, the CHIPS Act. But I think in some ways those are the reasons why the U.S. economy has done much better than most of the other economies in Europe or China or a lot of other places that didn't have that kind of fiscal policy. And I think in many ways, when you look at the prices of things that went up and the pattern they followed, it was much more directed by the things that were in short supply and that were disrupted by COVID, and then the kind of response to that, than it was by where the fiscal money was going. And you also, if you think about, other countries did not do the same fiscal policy we did, but they had very similar inflation patterns. If you look at Europe and you look at Canada, you look at a lot of other markets that did not do what we did, the same pattern in inflation, a big jump in 21, 22, and then starting to roll over now, even if they had very different fiscal policies, kind of tells you that it wasn't just U.S. fiscal policy that drove it. It was, COVID, the global shocks that were happening. And a lot of it was COVID. Some of it for a little while, I think it was Ukraine because of the oil and food price impacts. But a lot of that's really gone the other way now. And so commodity prices are way back down. Inflation in the US is down, but it's also falling in most other countries too. So you can't really tie it to just US policy if it's happening elsewhere.
Then it makes you wonder, does the policy matter then, right? If the policy didn't have an impact, then should politicians get credit for anything they did? It's like, well, doesn't matter that you did all this. You increased the debt, and we didn't actually end up in any better situation than the other countries that might have done nothing.
Oh, I think we have definitely much better off than the other countries that didn't do it. If you look at the growth rate of GDP and incomes and unemployment, the U.S. is way ahead of most of the peer countries in terms of recovery from COVID, economically speaking. And that's also showing up in U.S. earnings growth as well. Corporate earnings in the U.S. are holding up far better than they are in other countries. So I think the policies did work in the sense that they kept the U.S. economy doing much better than it would have otherwise, given the size and the magnitude of the global shocks that we had. I mean, they were really big shocks. So they required some pretty big, responses. And I think we also kind of learned the lesson that after the financial crisis in 2008, the fiscal response was kind of too weak. And we had years and years of basically too high unemployment and too weak a growth because there just wasn't the fiscal policy to support it like there has been more recently. So I think the U.S. has done a much better job of managing fiscal policy relative to other countries that don't have that kind of coordinated fiscal policy like we had.
Okay, so then that's a good way to think about it. It's not how I had been thinking about it before, so I appreciate getting to hear that other approach. I'm like, okay, we are doing better than other countries, right? Like I think most people would agree, hey, we're not Europe, we're not China, we're not some of these other places, and maybe that is the difference there. And that takes us to equities, right? That takes us to looking at U.S. equities. Certainly, if you've been in the Hang Seng for the last couple of years, you lost 50% of your money, right? And I think that's what people are afraid of here, right? People are afraid of, oh my God, I don't want to buy here at all-time highs. And I'm looking at 10 years where I haven't made the money back, right? It's like this, and it just doesn't come back. I'm afraid of a Hang Seng outcome, or I'm afraid of the Fed tries to cut, inflation comes back like a zombie, right? It wasn't dead yet. It's coming back. Here we go. What do you say to those types of fears? Because we hear a lot about that right now.
Well, no, I think you're right in the sense that U.S. equities definitely kind of look different than a lot of non-U.S. equities, whether it's the Hang Seng or even European equities. The U.S. has been outperforming the rest of the world really at least the last 10 or 12 years. It's been a long time now since non-U.S. equities have systematically outperformed the U.S. And a lot of that is because the U.S. economy is much sort of stronger and more robust, and earnings have grown faster in the U.S. than they have elsewhere, again, for over the last decade, not just recently. So there's a good fundamental reason for that, for the U.S. to have outperformed. And yeah, if you've been certainly in Chinese stocks have been terrible. And I've been underweight and avoiding Chinese stocks for a long time now. And the earnings, trends really corroborate that. The earnings have been much weaker, in China and a lot of other countries than they have in the U.S. So, equity allocation regionally does make a big difference. If you've been in non-U.S. equities, then yeah, you might have a different, kind of view of things. But overall, I think equities and U.S. equities and U.S. large caps in particular have been the place where the fundamentals have been best and have been best positioned to take advantage of the global trends. So like, large cap technology stocks, that's where a lot of the money has been going for years now. And the U.S. companies that are, dominant there have been the best place to benefit from that. So I think there's a sort of a general tendency for the U.S. economy to have done better. And there's a particular way that the U.S. equity markets are aligned to benefit from a lot of the kind of global secular trends that we've seen over the last few years.
The classic Magnificent Seven, right? U.S. equities, large cap, tech. We know what those companies are. Whether it's those seven companies or others that are similarly positioned, they're going even faster, way up higher, more so than the S&P 500 on an average basis, right? They're pulling up everything else. And yet you're saying you want to stick with large caps. You want to stick with these names despite the fact that they've run up enormous numbers here.
Yeah, that's right. I mean, there's some of it is, kind of the investor behavior, momentum kind of idea of, you want to kind of, at least in the intermediate term, stay with what's working and not try to fight the trend too much, because that can become very expensive trying to catch falling knives. But the other is that, yeah, again, the underlying fundamentals are there. I mean, the reason they've gone up a lot is that their earnings go up a lot faster than other companies have. and they have much better balance sheets, and they have sort of intellectual property and things like that other companies don't have, and so they're more resistant to higher interest rates. So that's why, even though a lot of people think higher rates are bad for growth stocks, or long duration stock as they're often called, that historically has not been the case. They're much less sensitive to interest rates than companies that are smaller or more cyclical or need to borrow a lot more. So the big cap tech stocks and other companies, are much more insulated from that than a lot of other companies are, and have the benefit of kind of the underlying U.S. economic growth. So yeah, to me, it makes sense in some ways still that I see stronger earnings estimate trends in those companies than I do in a lot of other areas. So as long as that's the case, I'm happy to go with them. Now, if that changes and their earnings estimates start to falter, the momentum starts to weaken, or they get so expensive that there's just no way to justify their valuations, then yeah, then I would become more cautious and want to look to other areas. But I don't see that quite yet.
That was going to be my question is, but they are very expensive, right? Or like some people think they're expensive. So when do you draw that line on this is too expensive? Because all the factors that you've said, I think we would agree a lot of people know those factors, right? There's nothing surprising in what you're saying. And that's why these stocks have gone up so much, right? So now it's a matter of, okay, I know they're up. I know why they're up, but I don't know how much more they're going to go up. So where do you draw that line on now it's too expensive?
Yeah, and like I say, a lot of ways, I'm kind of looking for those inflection points in the underlying fundamentals, and I track that by looking at the what the aggregated kind of indicators of what earning analysts are doing with their earnings estimates. At the margin, are they still raising numbers? Are there still surprises coming through and causing them to push their sales and earnings estimates up, or are they starting to kind of trim them or even cut them more aggressively? In which case, you'd say, okay, whatever the good news was has now kind of ended, and they're starting to pull back. So I haven't really seen broad-based signs that they're starting to cut estimates in those leading technology-related areas yet. That would be the thing that I would worry about. And if you think about an example like, I don't know, NVIDIA, where at the beginning of last year, it was very, very expensive on a forward PE basis, 3 times the market multiple, I think, something like that. But their earnings went up so fast that they're actually cheaper now than they were a year or two ago, even though they've gone up 200%, because the earnings have simply gone up even faster than the stock price has. And I think, again, nobody expected that level of earnings growth. Now, that's an extreme example, but it is still possible to surprise to the upside for some of these companies, I think. But that was really the story of 2023 overall. Most people came into last year expecting earnings to be down and the economy to go into recession, and it didn't. So that was better than expected. Now the bar is somewhat higher, as you said. People are seeing it more and expecting it more. So you'd have to have a little bit more to get things to go further out on the upside. But we still haven't seen things looking like they're turning down. And I think that's the key thing, that at least if you've got the interest rate inflation situation looking better and earnings holding up, you've still got on balance a case to be made for equities and some of those tech names as well.
I think that's a good point. Just thinking about like an NVIDIA example, it's gone up, but it's cheaper, right? For what's expected. So I think that's something for people to ponder and think about, right? It's gone up, but what you're expecting out of it, what do I say? Like the expectation is higher. Well, yeah, it's a higher expectation. So the price for what you're paying for that expectation is actually relatively lower than it was before. So that is a good point and adds some nuance, I think, to the conversation of, okay, do you want to buy something that's up 5x, right? It's like, well, but now their forward earnings is 10x, right? Or whatever the numbers, right? It's actually, you're getting a discount. The one thing that we didn't get to yet, because you mentioned stocks, you mentioned large caps, small caps. And I think that's a good point too, that the large caps are often less sensitive to rates. But then it means that rate cuts shouldn't help them as much, right? Like if you think there's rate cuts, wouldn't you say, okay, then the rate sensitive stocks should now catch up, maybe more of the small caps?
No, and I think that is a good point. And we've seen certainly the financials are an area that has been benefiting from the rally in the bond market that's kind of anticipating the rate cuts. And so what we would expect is if the Fed does in fact follow through and cut rates this year, that smaller cap companies that are more sensitive to short-term interest rates and they need to borrow and are more constrained in terms of their access to credit, those would be the ones that would potentially benefit more than some of the large caps. which tend to have much more cash and less debt, and are less sensitive to that sort of thing on a fundamental basis. So it may be that the lower rates will help stimulate generally the economy and housing and autos and other things like that in terms of consumer demand, but will also help those companies that have more restricted access to credit and have to pay more for it. If they see relief on that sense from the Fed, then they would get a benefit later in the year. So I haven't quite seen it yet. I want to see if the Fed really does kind of come through with this, but that would be the next leg, is to broaden out the base of kind of performance within the U.S. equity market, because I think that's the reason large caps, and particularly the tech stocks, have led, and small caps a lot of ways have lagged, is because of that relative sensitivity to interest rates, which have been going the wrong way for small caps and could shift later this year.
We haven't touched on commodities yet. And I know in your views, you see them as weaker. Are you expecting or afraid for a massive collapse in commodities this year?
I don't necessarily see a collapse, but I think that the general trend in commodities is probably going to be flat to lower. I think that a lot of commodities are pretty well supplied overall, including oil and natural gas. And I think a lot of only things that really have kind of tend to push the other way have been these sort of occasional shocks of, whether it's the war in Ukraine a couple of years ago, or concerns about the Red Sea right now. But those are all kind of temporary disruptions rather than real underlying supply demand things. And I think a lot of that is also tied to China. For the last 20 or 30 years, most of the incremental demand for a lot of commodities has come from China's growth and their demand for a lot of things. And they're really just not going to produce that kind of level of demand growth anymore. I don't think China's necessarily going to fall apart, but I don't think it's just going to grow anywhere near as fast as it had previously. And they don't have scope to sort of stimulate and to do that kind of really aggressive buying that they have done in past years. So to me, it's the fact that the global economy is sort of generally going to be slower, and China in particular will be less of a source of demand, and that there actually is plenty of commodities around for what we need, given that demographics and technology and all that kind of thing tend to be kind of disinflationary influences over the longer term anyway. So yes, I'm underweight commodities, and don't really see them as an area to go into unless you're going to bet on a supply shock of some kind, which is certainly, of course, hard to predict.
Why did China just screw up so badly, right? The whole idea of command and control economy, one party system. We will tell you what to do. We are so smart. We're the threat. We're going to be the great blah, blah. And then it's like, this is not working, right? And they, the whole idea that the Americans are dumb and look at the West and look at us, and it's not working, right? So where did they go wrong where they have full control of their government? They have full control of everybody. They can do whatever they want, and they can accomplish those things if they want to get it done. Did they focus on the wrong goals? Are they incompetent? Is it corruption? Because they have all the natural resources. They have a lot of natural resources they build everything. So I'm very confused. And I think a lot of people are too.
No, you're right. And there's been a lot of discussion and kind of confusion, I think, about what's happened with China. I mean, I think big picture, there's a lot of things going on, and certainly things like corruption and having a one-party system there's downsides to that for sure, and they're realizing that now. But I think a lot of it is really just that their whole structure is different than what we think of, in the sense of they basically decide what they want GDP or whatever to be, and we want it to go up 6% or 8% or whatever number they choose, and then they just go out and build things to make it happen, even if they don't actually need them. So there's been years and years of trying to sort of use building bridges and roads and apartment complexes that people can't afford to live in, all these kind of things that they didn't actually need, just to make GDP growth look better and to kind of keep things going. And now they're kind of realizing they have all this excess stuff, and households don't actually have money to spend to do it. And so they have a very big mismatch between kind of the export and infrastructure driven spending that they focused on versus kind of domestic consumption, which is what you really need to have kind of long run real growth. Whereas the U.S. has been kind of more the opposite, and has been runs a trade deficit, has a much more consumer driven economy. So I think 30 years ago they needed to build a lot of infrastructure. They didn't have it. Now they do, and they're still building it. And now they've kind of over invested and did malinvestment, and are now having kind of take write-offs on real estate and all these things. But they don't have a system designed like we do, for companies to go bankrupt and take the loss and write it off and then move on. It kind of just stays there and waits for the government to do something about it. And that's a very sensitive political process. And so a lot of things that would happen in our system wouldn't happen over there, at least
Oh,
in the
is that
same time
true? I,
frame.
I didn't realize that. Talk to me about this bankruptcy or lack of bankruptcy option there, because that is one of the great features of the American system, which is what allows entrepreneurs to be like, you try it, you fail, you try it, you fail. Someone's going to eat the money on that, right? But at least you can have your 9 lives and you can keep trying. And we know a lot of great companies are from multiple previous failed entrepreneurs.
Oh, sure, yeah, no, exactly, and that's the thing is that we have a system that's more designed to have failure and then you move on, and as long as it doesn't become systemic, where the banking system or the whole economy is threatened, then that works reasonably well. But if you're in a one party system and you have where it's designed to be really top down kind of driven, then admitting mistakes or saying something failed is a very different proposition. And that you have to, if you're kind of agreement with your the populace is that you let us be in charge and we'll make sure that growth continues no matter what, then you made a promise you can't keep. And that's, I think, what they're running into now, is that they just can't keep growing in the same way, even though they keep trying to. And then they're realizing that keeping building things you don't need is not a good way to structure the economy.
So that's why you wouldn't even buy even on those lower prices or at the lows here, because you think just the structure of how they've set up their government, their capitalism system, you think the structure is so bad that you wouldn't even want to come in here at these lower levels.
Well, I'm never going to say, don't buy something ever. There's always a price for everything. But what I see in my, again, in the earnings estimate data, looking at the, company level, 600 or 800 Chinese companies, and looking what the analysts are doing with their earnings estimates, they're not, they're very weak. They're still, cutting their earnings estimates pretty aggressively across a lot of different companies in China and Hong Kong. And so that tells me that whatever's happening over there, there's been no real signs of improvement at the margin. Things aren't getting, less negative to the degree that you'd want to see to really put money in there. And so if you have structural issues, you have issues of, whether, high technology, chips and things from the US or elsewhere are going to be able to, are going to influence their growth. So they have geopolitical issues and they have kind of bottom up fundamental issues in terms of their earnings. I would want to see some of that needs to change to make me want to take a longer term, view on it. And certainly tactically, you could trade bounces, and there's, maybe short term things you could do, but so far I haven't seen evidence of the fundamentals really changing there, and therefore even if they are somewhat cheaper, they have to get really really cheap, which they aren't yet, or fundamentals get better.
I'm looking through your research here as you go through some of this, and it's got a lot of details, right? But you keep talking about this model of yours, right? Your benchmark model, overweight, underweight. Walk us through what this typical model looks like, because you've got cash, long-term bonds, small caps, large caps, equities. I'm curious what the model is, and then I'm curious, is this how you actually invest your personal money?
So I try to keep my personal money pretty conservative, just because I want to make sure there's no conflicts of interest with what I'm telling people to buy versus what I'm doing myself. And Mill Street Research does not manage anyone else's money. So just to be clear, that whatever advice I'm giving is sort of straightforward, meaning that there's nothing else going on that I have another incentive to.
You're not getting paid by somebody to say something. Yeah.
Right. Yeah. I can be bullish or bearish. No, there's no investment banking. There's no trading operation. There's no asset management here. So the idea, is to have an objective anchor to, what I'm doing. And that's really been my thing my whole, the last 25 years I've been doing this, is to have, testable objective indicators that will keep me kind of focused on what matters and not get distracted by what's in the headlines. It's very easy to read articles and things and say, oh, this must be, what's most important right now, or I should buy or sell based on this. And then only to find out, well, everybody knew that, or that's old news, or it's just not relevant. So the global equity risk model, for instance, that's kind of the cornerstone to my, risk on, risk off views, has 8 different indicators in it. And they're all, designed and tested to kind of tell you what's going on in different aspects of the market and which ones are bullish and which ones are bearish. And if the majority of them line up bullishly, then it's usually historically been a good idea to be bullish and vice versa. So that gives me a way to objectively say, this is the set of indicators that I trust, and they're telling me that right now this is a bullish scenario because equity price momentum is good, volatility is pretty low, credit conditions are good, the Fed may be lowering rates soon. Those are all conditions that have historically been pretty good over, say, 3 to 6 months, looking out for equities relative to, say, cash or bonds. Same thing with the small cap, large cap. There's a model there that tries to figure out, what part of the cycle are we in? Are we in the early stages when small caps tend to lead, or are we in the later stages when large caps tend to lead? And it's been kind of telling me later cycle lately, so that's why I've been favoring large caps. But again, I want to have something that I can test and anchor and kind of point to, and clients really seem to like that. They want to have something objective that they can kind of analyze and follow along with me.
And just tell me a bit about, who is Sam Burns, right? Where did Mill Street come from? What were you doing before you launched this?
Yeah, so for a long time, I worked at different investment research firms. I started off in Ned Davis Research down in Florida about 25 years ago. I was there for about 5 years, and built a lot of models, did a lot of writing and things there, and then moved up here to the Boston area to work for State Street Global Markets. Again, doing similar kind of macro quantitative research. Then I worked at Brown Brothers Harriman for a little while, and then Oppenheimer and Company until about 2016, when I started Mill Street Research as a way to kind of pull together all of the work that I've been doing over the years into one place and be able to do it independently, not having a big brokerage firm or investment bank or whatever kind of looking over my shoulder and telling me what to do. That I could do it my way and give clients exactly what I thought was good and what they wanted without any kind of constraints. And so I've been doing that, for 7 or 8 years now, and mostly deal with institutional clients, but anywhere from a big mutual fund company all the way down to small investment advisors or anyone in between.
I like that you said that you left sort of big corporate because you don't want people looking over your shoulders. You wanted to be able to have those shackles removed. What should the regular investor out there be concerned about when they're seeing the big corporate research, right? The big businesses out there. Like you said, you're avoiding conflicts of interest. You don't have all those other businesses that are trying to make a buck. What should they be, watching out for when they see research that maybe has a bias towards it?
Yeah, I mean, there's a lot of kind of subtle things that go on there. I mean, one of which is, of course, if you're in a brokerage business, then your business is to sell stocks. So if you have an incentive to be bullish or to tell people to buy stocks, if you tell them to get out and go to cash, a brokerage firm isn't going to make any money from that. So brokerage firms will tend to have a bullish bias just by the nature of their business to what they profit from. The same thing with advisors who might recommend certain funds and things that they get paid for, or if they have investment banking, they might want to tell you to buy stocks that they've done investment banking underwriting for, that they would get profit from trading themselves. So there's a lot of ways that in the background, companies like that can profit from things that are not to your benefit as an individual investor reading them. Now, there's still a lot of useful information you can get from them, but you kind of have to read it carefully and make sure that the information you're getting from them is less about do I buy or do I sell, but is there information about how this company is doing, how the economy is doing, that I can then use to make my own independent decision about what I think is useful for my economic asset allocation portfolio. So having like an investment advisor that works for you on a fee rather than just what a brokerage firm tells you can often be a better way to do it because you have someone that you can talk to who's an expert but is also not conflicted. And that's why a lot of the people that I work with are investment advisors in that way.
And then do you think the era of picking stocks individually is gone? Should everyone just become active, passive index investors? Or do you still think there's opportunity for a normal person to get information that the marketplace doesn't have and then start to invest on that? Because that's starting to feel very rare right now.
Oh, yeah, you're right. It's definitely much harder now to be an individual investor and manage a particularly an actively traded actively managed individual stock portfolio. There's nothing to say you couldn't do it, but there's just the competition is extreme right now. So yeah, I think a lot of people have shifted towards ETFs and other things that are portfolios essentially, and that reflect some sort of investment thesis or idea of, whether it's you just kind of pro technology or your growth, or you like value as a principle, or, kind of general investment kind of approaches rather than individual, company analysis, which is just very time consuming. And most people don't have time. I mean, if you have a day job, you don't have time to sit there and look at all these financial statements and the markets and everything all day, every day, which is kind of what you would have to do to really build your own stock portfolio and expect to outperform consistently over the long term. So I think it's just a matter of time and resource allocation that most people don't have now, and that you have to either rely on an advisor or pick funds that just match your kind of personal investment beliefs, and that you're going to hold on to for longer periods. And that there's a million choices now, and it's much easier to find a fund that aligns with what you are looking for now, which is great. A lot of them have much lower fees than they used to, which is also good. But it is harder to make a stock picking case nowadays.
I noticed in your research, it's not like you're picking stocks, right? You're talking about macro stuff, right? Treasury bonds or S&P 500, that kind of stuff. China versus US, very big macro. You're not saying, hey, go buy this random stock that I'm talking about.
So now I do sort of pick stocks in the sense that I have a quantitative ranking model for stocks for institutional investors.
Okay.
But again, it's not necessarily for the average person to try to use, because again, it still requires a certain amount of knowledge of the markets and sort of consistent oversight. It's meant for a portfolio manager primarily who comes into work every day looking for stock ideas, or to check their own portfolio ideas and see if my quantitative model agrees with them or not. So again, the stock selection work that I do is helpful mostly for institutional managers who have to do this all day, and to be able to build those kind of aggregated indicators to see if there's a lot of stocks in one sector that screen well right now. That's a clue. If there's a lot of stocks that screen badly in one area, whether it's China or commodity sectors or whatever, that's another indication that, okay, you might want to avoid that area. So there is a stock selection component to my work, but it's not what you think of as kind of looking at the management and visiting the company and kind of the traditional fundamental micro research that you would normally see. It's meant to be an adjunct to what institutional investors do.
And then what is something that it's just a big red flag for you right now in terms of investments at the moment? When you read the news, when you see some kind of hype cycle, is there something that you just think everyone needs to just stay the heck away from X? Like, what would that be? Or what are you staying the heck away from?
I mean, a lot of what I see at the macro level is sort of the excessive doom and gloom, essentially, saying that the U.S. dollar is going to collapse and become worthless. Or that the U.S. Treasury is going to go bankrupt or won't be able to issue debt anymore, or things like that. Those kind of like big macro scare things, really, I've been hearing them for a long time, and they've been wrong for a long time. But those kind of things, worry me when I hear them, because it'll cause people to basically, become scared and only hold cash or Bitcoin or something, and miss the other opportunities that they might otherwise have had. And but otherwise, any kind of really extreme views, up or down, kind of make me a little nervous, because it's pretty rare that that's going to be the right way to approach things, overall. And then other than that, it's going to be specific things where if people take too extreme a view on, say, real estate, most people say commercial real estate is horrible, you should avoid it at all costs. Some of it is, but some of it's actually starting to improve. So again, you want to be careful about making too many sweeping generalizations, or all tech is the Magnificent Seven. Well, it's not. There's actually a lot of technology companies that are doing pretty well. It's not just the Magnificent Seven, and even not all the Magnificent Seven are doing very well. Apple isn't doing that great, for instance, on an earnings basis in my work. So it varies. You have to kind of look at it more closely. So when I see those kind of simplistic, extreme views, it makes me nervous, because it's people trying to get attention more than trying to give you useful information.
So what's funny is on this channel, anything doom and gloom, that's what's going to get a lot of viewership, right?
Oh, absolutely, yeah.
And I've seen tweets where people say, oh, anything, and it's like other people tweeting, other financial guys saying, hey, whenever we have something bearish, it gets 10 times as many views as when we have something bullish. And so even part of this conversation, I'm trying to get you to say something that's a little bit scary because that's the headline to get people to click on it. But I was thinking about it before you said it. You're very moderate. Everything you're saying is in line, right? And we just had a conversation yesterday with somebody. They do commercial real estate and they're seeing a lot of positives. And I'm like, wait a minute. Everything I read was negative. And they said, no, but we're in the right areas where it's growing, where we don't have any vacancies. We've just got all occupancy, right? And so it is like you're saying. And I do think there's this weird dynamic, especially with, something that's going to be on the internet, a financial show. There's a
no,
lot
economic.
of media value in doom and gloom, but there's not necessarily a lot of economic value in it.
Yeah, no, and that's really what I've seen. It's really been dramatic over the last year or two, but that's always been the case. That doom and gloom sells. It gets more clicks. It gets more headlines, and uh, it often will sound, kind of
It sounds smart.
smart, yeah, and it sounds like very contrarian and like you must be on the right side if you're going against traditional conventional wisdom or whatever. But then you look at the track record of some of the people saying these things, and it's not working. So I think you have to be real careful with that kind of stuff about whether it's kind of looking for attention or trying to give you useful information. But it's been economically speaking, the consumer sentiment surveys, for instance, University of Michigan and consumer confidence surveys have been way more negative than the academic data would normally suggest it should be. And so up until about 2019, there was a pretty tight correlation between unemployment, housing activity, stock market, earnings, all those kind of things were pretty correlated with what consumer sentiment was. And then all of a sudden, after COVID, it broke. The economy got a lot better, and sentiment didn't. And I think there's a lot of that kind of media influenced thing where people say it's bad, and people believe it, even though it's objectively not. And I think that's what caught people off sides at the beginning of last year. Everyone's saying the market was going to go down, and then went up, and now they're still catching up to that because it's all focused on what they see in the media as opposed to the underlying, hard data.
It's funny if you ask some of the doom and gloom people what they're invested in, they're still long anyway.
Right.
Well, I'm not going to be short.
Yeah. Which is what you would logically assume if you believe what they were saying. You'd be short everything and then just in cash or gold or something. And they're not usually. So that's been the real thing that I've kind of watched, particularly being on social media and everything else, has been a really stark dynamic. And I have clients come to me and say the same thing. Like, well, everything's terrible, right? We're going into recession, right? I'm like, we might someday, but it doesn't look like it right now. And, not for the last year, 18 months. So, the Fed raised rates so much. Yeah, but fiscal policy helped offset that. And, the economy was recovering from COVID. And, there's reasons why that didn't have the same impact it did in 2007. So we're probably not going to have another great financial crisis.
What about the fears because we see other countries, right? You see China, right? Kind of imploding a little bit, or you see countries in Latin America where the currency is worthless, and you see currencies that get devalued. You see inflationary shocks in the thousands of percents, and we see it, and it's happening. It's in the world, and it's right now, right? Like we know that's true, and it's just this question of, is the United States turning into that because the debt is massive, right? Because there's, what do you want to call it, a border crisis or a political, division in this country. Like there's enough things that people can point to and it makes them concerned, right? Or it's, hey, the sentiment is bad for whatever reason, right? And if the sentiment is bad long enough, it's going to create people to behave in a certain way, or the idea that the average shareholder, stock owner is doing well, but the average person who maybe isn't in stocks, they're getting hurt because, okay, inflation's going up and income's going up. It's like, do you put any value in the idea that people are genuinely concerned? Like, I see bad countries around us and I see bad policymakers, and I'm afraid they're going to put us in that position.
No, you're right. Yeah. I mean, a lot of other countries, have had big problems. Yeah. I mean, whether it's currency devaluations or high inflation or anything else. And those are almost always traceable to, terrible economic policies and structural issues in their economies. A lot of them are small, much smaller economies that are more dependent on, foreign funding and things like that. The U.S. is different in many ways, partly just the size and diversity of the economy, but also the dollar, of course, being the global reserve currency, but having our own energy sources in many ways. So Europe, for instance, has had a lot more trouble with energy costs than the U.S. because they don't have their own oil and natural gas to the same degree we do. Um, but a lot of it, are longer term structural issues. Like I say, what we talked about with China, a lot of that's been years and years in the making. So this isn't, and so COVID kind of set some of this off in China and elsewhere. But it was sort of the match on something that was already set to burn. Turkey or Argentina are these places that have very very high inflation rates. That's just years and years of just gross mismanagement by a multitude of different leaders, just pursuing economic policies that weren't sensible at all. And so to me, you certainly want to differentiate those and be careful if you're going to invest in anywhere that you think has wobbly, leadership or economic policies. And Europe, is a problem because there is no, of course, central European fiscal policy. It's a collection of a whole bunch of different countries. They have one currency but no common fiscal policy, and so they can't really coordinate, unemployment benefits or banking systems supervision or stimulus or whatever. They did a little bit of that in COVID, but not much, and they've struggled as a result. So I think there are some things that are structural like that, where you have a currency union without a fiscal union, or you have a one-party system in China that tries to dictate, growth when it's not really there, or things like that. And those can take years to kind of play out, but eventually, the kind of things come home to roost. But I think the U.S. has done a better job of that, partly because of our structure. It's just much more open and kind of capitalistic. There's your freedom to fail, and because our policies have been a little bit more dynamic and willing to respond to it. And so I think as much as people sometimes complain about the Inflation Reduction Act or the CHIPS Act or the Infrastructure Act, I think those are actually critical in keeping the U.S. economy in better shape than it would have been otherwise, again, compared to a lot of other economies. And I think as long as we can continue to make at least somewhat sensible economic decisions, then that's going to help. I think if we get, debt ceiling crises, which is just a made up thing, or, government shutdowns, things like that, I think that's going to be, problematic. Luckily, we've managed to avoid major problems like that historically. But I think people focus too much on, things like the federal deficit, and less on what they're spending the money on and how, and, what it's doing. And I think if you're investing in useful things, then that's good. And so I think you have to think about not just, how much money there is, but where it's going and what it's doing. And that gets overlooked a lot. Again, the nuance.
I appreciate that. I appreciate that context. It's really good. Really good. Sam, thank you so much. Eye-opening discussion on how you're thinking about things and getting to moderation back. You might only get like a few views for this because you're not scaring the world into just putting cash in the mattress.
Yeah, no, I know. Yeah, it's hard sometimes thinking about what will sell or get the clicks versus what is more likely to be right, or what investors can really use to manage their portfolio. And so I've tried to resist making extreme points of view just to get the attention. I'm here again as an independent research provider to try and give good advice, and have a sort of a long career for that. So whether it's maybe less exciting, but hopefully more accurate.
Or I was going to say, that was my question: is would you rather your career be more accurate, or you're selling more newsletters? Right? Which one matters more? Right?
Well, right, and sell more newsletters today, or people realize that your advice isn't very good, and they stop buying it, a year or two from now, and then you kind of have hurt your reputation. So again, whether I'm right or wrong, I at least figure like I have objective indicators I can show you that have that I can test, and I can walk you through the logic of what I've said and why, as opposed to kind of more extreme views that are harder to when you dig into them tend to fall apart.
That's why I asked about your personal investments, because it was interesting to hear other people who are like, oh, I'm doom, but I'm long all these things because if you go short, you're going to get blown up anyway. So that's why I was curious, yourself.
Yeah, no, I'm long equities. Yeah, I have equities in my portfolio. I'm overweight stocks. So I don't do, let's say I don't do a lot of active trading, but right. I do kind of more or less put my money along the lines of what I recommend to other people.
Like following the model, basically.
Right.
And then where can people to get more? So it's millstreetresearch.com. What are some other ways? Maybe are you on social media? Where other ways can they can follow you directly?
Yeah, no, so on Twitter is probably where I'm most active. So it's at MillST Research on Twitter. So I'll post there most days, kind of macro views and kind of highlights of some of the work I do, sectors or regions or stock selection. Also on LinkedIn, again, there's a Mill Street Research page there you can follow where you can catch up on things. There's a blog that I update periodically on the Mill Street Research website. You can go to the website and put in your email and get free get updates whenever the blog is updated to get in kind of just to get a perspective on things that I'm saying. There's sample reports there as well. So if you're interested, you can certainly find a lot more. But yeah, I'd follow Mill Street on Twitter and LinkedIn.
Awesome. Sam, thank you so much. Thanks for everybody sitting through this and listening and learning. We really appreciate it. Of course, if you like this episode, like it, share it, subscribe forward, go to Sam's website, check out the newsletter. Of course, go to wealthion.com. You can check out all the information about this episode and many more over there. And if you're looking for some other investment advice or someone to help manage your portfolio because you're trying to figure out what to do with all this information, maybe you don't want to do it yourself, we've got a form there. You can connect with investment professionals that we vet. We can, we have relationships with here at Wealthion that we can connect you with. There's no cost. It's just a free public service that we provide. Hopefully we can help families figure out their finances and their investments. So that's at wealthion.com. You can also check out our other shows as well. Anthony Scaramucci has a show. If you want some different hot takes and opinions once a week, he's got the live Q&A Fridays at 11. You can fill out the form there, submit your questions at wealthion.com. He'll answer them on the show. Sam, thank you again for joining me. This has been really a pleasure, really a treat. Thanks so much for coming on Wealthion.
Oh, my pleasure. Thank you for having me on.